The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money podcast with Alistair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair MacLeod on behalf of GoldMoney. And with me on the line somewhere in England is Peter Warburton, who is Director of Economic Perspectives Limited, which is a consultancy, and he's also Managing Director of Hawkins Services Limited, which is an international risk analysis service. He has written books, and I think the most notable one is Debt and Delusion, which he published in 1999. Welcome to the show, Peter.
Pleasure to be on.
I was just thinking, where actually are you in England? You're not in London, are you?
No, our office is in Luton, so where the rents are lower, but the rain still falls.
Yeah, well, I'm in Devon. The rents here are lower and the rain falls, so you and I both. I did a little bit of digging before this, really to sort of get a little bit more of an idea of what you've written and all the rest of it. And I came across something which really intrigued me. You wrote an essay which was released, I think, in 2001, so 11 years ago. And I think actually it's a very, very descriptional part of it is a very good description of what we have at the moment. I'll just read out the bit which caught my eye, if that's all right. And it's headed, "Central banks are engaged in a desperate battle on two fronts. What we see at present," this is 2001, "is a battle between the central banks and the collapse of the financial system fought on two fronts. On one front, the central banks preside over the creation of additional liquidity for the financial system in order to hold back the tide of debt defaults that would otherwise occur. On the other, they incite investment banks and other willing parties to bet against a rise in the prices of gold, oil, base metals, soft commodities, or anything else that might be deemed an indicator of inherent value. Their objective is to deprive the independent observer of any reliable benchmark against which to measure the eroding value not only of the US dollar, but of all fiat currencies. Equally, they seek to deny the investor the opportunity to hedge against the fragility of the financial system by switching into a freely traded market for non-financial assets." Peter, I think that's quite remarkably prescient because I don't think anyone could describe what's going on today in more accurate terms. I mean, do you see exactly the same situation as when you wrote that?
Yes, obviously it's always a bit scary having something that you wrote in the past read back to you. But no, I mean, I think the game hasn't changed a great deal, but obviously our understanding of various aspects of it has. And clearly one thing that's changed since 2001 is that gold producers are no longer selling forward their production, and central banks are no longer in the main selling their gold. Indeed, quite a few of them are acquiring gold. So we've moved on quite a way, and so there might be some central banks who would want to exclude from my general provisions of that time. But no, I think the search for inherent value, I think, is as difficult as ever, and obviously it's leading to some very polarized opinions about investment.
Yeah, absolutely. No, I'd agree with that. And I think the point you make about gold is well made. It has changed quite a lot. I mean, since you wrote that, the central banks in the emerging markets have turned into buyers, and particularly the Asian central banks. And I think this has brought a degree of uncertainty for the central banks in the more advanced economies, because there is a transfer, perhaps, of gold, I think, from Western hands into Eastern hands, which surely in strategic terms must raise, I think, some fairly important questions. So I would agree the whole thing has changed a lot. But the other thing that caught my eye was, the first front, as it were, that the battle is being fought on, and that is, trying to stop the financial system from falling over underneath this weight of debt. I mean, that I think it was interesting because when you wrote that, or at least when you published it, I think I'm right in saying that the dot-com bubble had just about burst, and certainly I think any forward-thinking economists such as you would probably have seen the dangers emerging from the popping of a bubble. And yet Greenspan then rescued it by printing goodness knows how much money. I mean, it was just beyond imagination. But anyway, he managed to turn it round. And here we are now some time later facing the same financial Armageddon, I suppose. Do you look at it that way, Peter, or am I being too simplistic?
I think it is a complicated situation, and obviously central banks have employed a number of different strategies along the way. Typically, they've had to invent new strategies because old ones were no longer working. So, obviously, the realm of quantitative easing or central bank asset purchase on a massive scale, that's relatively new to us, and I think we're still understanding, some of the distortions that creates. I think the critical observation really is that the determination to avoid a Lehman-style event, is if not absolute, it's certainly very, very great. And you'd have to say that the central banks have been really quite successful in really suppressing default across the spectrum, but particularly from preventing the default of an important financial counterparty. So I think my conclusion would be that this remains absolutely central to their efforts, basically to get the financial system with enough buffers in it, liquidity buffers in it, that were, something catastrophic to happen, then there would be immediately the resources to rush around and neutralize it. So I see the threat of a impromptu financial deleveraging as the prime threat to financial stability.
Yeah, I think certainly the central banks, I think, have emphasized that. There is a tendency for regulators to tell banks to increase the amount of primary capital they carry on their balance sheets, and this encourages them to delever, perhaps, while central bankers are sort of trying to replace bank credit with raw money. Have I got that? Sorry, have I got that one about right, do you think?
Yes, I think you have. I mean, personally, this battle really that you describe is, I talked about the battle of the meta-narratives. Basically, there's a reflationary narrative, which the central banks obviously are driving. But there's also a regulatory narrative that the politicians are driving, seeking to make the system safe in some very naive and simplistic way. And unfortunately, we're now discovering that the onward march of global regulation, is quite a powerful counterforce to the central bank's reflationary actions. So, it may be that we're close to the point where we could get some relaxation of certainly of the capital requirements, which are proving, I think, so destructive to the stabilization of the financial system.
But that's interesting. But do you think that the genie is being let out of the bottle a bit? Because we now have a situation where the public, I think, understands that the bank which they bank with may not be a stable institution. And this would be particularly true, say, in countries like, sort of Spain, Italy, possibly even France, certainly Ireland. Do you think that on the one hand there's that problem, and on the other hand, all this sort of debt that the banking system has is effectively being underwritten now by sovereigns, and the ability of sovereigns to carry this must be surely creating an awful lot of uncertainty in the markets, and if you like, discouraging normal entrepreneurial activities like investing in new businesses, new products, and so on. Do you think that's a real problem?
It is, and it's a bigger problem than I imagined even that it would be. Obviously, we've had now pretty much 4 years of very low investment in terms of the net of depreciation, capital formation in the major developed economies. It's basically barely running it even now at above net replacement levels. And I mean, I'm not. This isn't an original thought, but the idea somehow that the central bank use language like "we'll do whatever it takes" or "we'll do unlimited QE," dependent on on some evolution of the unemployment rate. The message that sends to someone who's considering a major project investment is a very negative one. It's really saying that we the central banks will potentially drive down your real return on your investment as a side effect of our policy. So I think there's a big discouragement and uncertainty that comes to when it comes to making significant, and certainly multi-year commitments.
That's interesting, because I think that really what you're saying, putting it another way, is that government-induced uncertainty is probably one of the major hurdles now to economic progress from here. And so, looking at the global economy, or I suppose the components we can understand, America, Europe, and the UK, perhaps because we're in the UK, or Japan as well, do you see any meaningful economic progress over the coming years, or are we sort of zombified in the way Japan has been for so long?
Yeah, I think there is a likelihood that the global pace of economic growth will slow, and maybe it will not slow dramatically, but I think it will slow progressively until there is some very significant event. Now, one significant event would be basically, let's say, a 50% rise in the price level spread over 3 to 5 years, and that's certainly what I consider to be a very likely scenario. So that would then have a cleansing effect on the system. Almost certainly would be accompanied by some kind of a negative period for economic growth, but we could emerge from that much less encumbered by debt. So I mean, that might be a story for economic recovery in 5+ years' time. But I think the difficulty that we have is that the more likely we make a more pronounced slowdown now, the more it will seem to reinforce the politicians' desire for additional bank capital and liquidity and so on. I think if we can escape that significant downturn for the next couple of years, then there's a hope that somehow we can start to push back some of this regulatory imposition and create a bit of room. I mean, I'm not so dogmatic about. Basically, I think that in a human society, it's natural for there to be a life cycle of credit, and for young people to be net borrowers. And the idea that nobody can borrow is absurd and very, I think it's very restrictive and negative for the development of of young people's abilities and and aspirations. So there's lots of old debt that ought to be written down and written off, but I'm not against the creation of new debt in the context of the life cycle. So I think basically at the moment what we have is we have regulatory impositions which use categories of debt like bank loans and mortgages. They don't discriminate between the vintage of those debts or indeed the standards of underwriting that have been applied to them. So I think we've got a very ham-fisted and inflexible regulatory framework that is not allowing what reasonable recovery of private credit should be occurring.
Can I just clarify that a little bit? Because are you saying that there should be more regulation that is then imposed upon the markets to try and work out what sort of debt is preferable to debt that isn't? Or are you implying that there should be less regulation to free things up so that banks could take, if you like, a more constructive view on which customers to serve?
Yeah, I'm definitely the latter. I mean, I think the only additional point that I would make is that there's enormous empirical evidence to show that the failure rates of debt vary enormously between the vintages, is when the credit was written. And I think it's a great shame that we haven't sought a solution to our banking problems that has made this distinction. So in other words, you could create some kind of bad bank structure around, loans written, say, between 2005 and 2007 or something like that. And then, that would allow you to see more clearly the integrity of the rest of the system. But we didn't do that. So yes, I think the only way that we can go now is just to ease off generally on the regulation and move to some simpler structure of regulation, for example, around a bank leverage ratio.
Yeah. I'm all in favour of less regulation because, my take on regulation is that now when you go into the bank, the regulator is more important to the bank than the customer, which I think is putting the cart before the horse a bit. Anyway, we now have, I think, huge pressures to increase tax on higher earners. If you like, the people who make money by being entrepreneurial. And would I be right in thinking that that is destructive to the economy? Yet we still seem to be going ahead trying to do that. The end result being perhaps we end up collecting less tax than we might otherwise. What's your view on that aspect of our economy?
Yeah, I think it can be counterproductive to seek to raise money, in a very obvious way by, having additional tax bans and punitive tax rates. I think that's more politics than practical tax policy. What I would say, to the extent that there is a societal reaction to inequalities of wealth and income, then it may be for the stability of society that has to be addressed in some way. I don't think that punitive tax rates are the right way. I think probably the scaling back of reliefs and exemptions, I think that is a more sensible way if the need is felt to address those issues.
Yeah. Changing topic somewhat. We're watching the European, or rather the Eurozone problems I was going to say progress, but I think not progress is probably a more accurate description. How do you see that being resolved? Is there any solution to it, do you think, or is this something that's just going to, collapse around us?
Yeah, I think this is a system which is not likely to fracture, despite all the obvious stresses upon it. That relies on a number of assumptions, and they may in the end turn out to be invalid. I think the problem clearly is that the unrest that we've seen in Greece and Spain, it could escalate to a different level at which fractured solutions become very much more probable. But I certainly hope that isn't the case, and I don't expect it to be. Basically, when the euro was instituted, there were two paths that were potential for it. One was to become a refuge of the strong, and for some of the weaker countries to be forced out of it. Another way would be for it to be the refuge of the weak, and in the end for some of the stronger countries to abandon it. And the presumption in most people's minds for a long time has been the former. I think backing the euro to remain a store of value, obviously lots of Asian investors have decided that they were happy to back that story. But I think what we're seeing is the other narrative playing out. I think the destiny now of the euro is to be a structurally weak currency, with no obvious rallying point if Germany and some of its acolytes were to leave. We might still be 3+ years away from a practical scenario of Germany leaving. But as the ECB extends its mandate, and so essentially in Draghi, the ECB has somebody who is not dissimilarly minded to Bernanke, and is really quite sort of passionate about the challenge of keeping the system stable. So my assumption will be that the ECB's balance sheet will expand dramatically in the next year or two, and that the resources will be found one way or another to keep Europe together. And who knows, maybe even Greece will still be there. But
yes.
Obviously, it really depends what the outer limits of that expansion are.
Of course.
But I think the path along which we're travelling is one towards value destruction and basically socialisation of the problems, and Europe seems to be particularly disposed to that.
Yeah, no, I think that's right. I was interested that everybody's been saying, well, of course, Greece should leave, and it's a sort of Keynesian argument that if the currency goes down, then they become competitive and their exports recover, and then the government gets tax revenue and all the rest of it. That's which I think flies slightly in the face of experience. And I was interested in your breakdown of, it's either for the strong or for the weak, because I think that is where the fault line lies. And one wonders how long the Germans can continue to, if you like, stump up the money. I know it's being printed to a degree, or the balance sheet is being expanded at the ECB, but the burden on Germany is absolutely enormous. I think we're looking at $3.5 to $4 trillion when I talk to economists familiar with the situation both in Germany and elsewhere in Europe, and that is considerably larger than Germany's GDP. Do you think they can continue to do this? I mean, it's quite an ask, isn't it?
It is. I think I get very different answers depending on who I speak to as to how well understood the potential liability of Germany is to to this evolving disparity in the system. And if you believe that German politicians and the German electorate were largely unaware of the shadow transfers taking place within the Target 2 clearance mechanism, I think you could possibly justify, the way things are, which is essentially that 70% of the German electorate seem perfectly happy to endorse the Euro system in their choice of political party. But I do wonder whether there isn't a day, a dawning when more people understand more about the contingent liabilities. In other words, particularly the liabilities that would accrue to Germany, or rather the losses that would accrue to Germany, should the system disintegrate. It's difficult to reach a good answer to this question, but I wonder. What I don't understand is why Bavaria or some of the other richer Länder in Germany, why don't they appeal to the German Constitutional Court and say, look, if this system goes wrong and Target 2 has to be abandoned, Germany could be on the hook for 150, 200 billion euros easily, maybe more, of losses on redenomination of countries that leave. And as wealthy states, wealthy Länder, we are going to take our hit as a share of this loss, and we don't like what we see. But for some reason, that action is not being raised, and so that the profile of these hidden transfers, is still largely unappreciated.
I think that's right, my feeling on it is that they are in it so deep that nobody actually dare sort of contemplate getting out of the system or undoing it. Plus, the political elite is so focused on keeping the Euro project together that they daren't even contemplate a plan B. Just sort of switching again very slightly, you did mention earlier that you felt that the price level over the next 3 or 4 years should rise significantly in order to presumably devalue the real cost of outstanding debt, but also presumably as a result of the expansion of raw money that we've seen over the last few years. How do you see inflation progressing, and do you think that this has much of an impact on the value of precious metals in particular?
Yes, okay. If I can start by saying that the significance of what the central banks are doing, I think, is to completely neuter themselves in terms of being able to tighten policy when they might decide they want to. Basically, what's constraining bank credit from growing and money supply from growing much faster is almost certainly regulatory capital constraints. So in my story, I'm not talking about a money multiplier. That belongs to a world that we've left behind. So basically, my story is there are two reasons why if you like, the velocity of money rises in an economic system. One is because people are confident that things are getting better and the future is going to be better than the present, and they're happy to spend money and do things. So that's one justification or motivation for money velocity to rise. So in other words, a fixed money stock just financing more transactions and potentially more inflationary transactions. But the other one is that people are frightened. They can't see a resolution of the public debt and the sluggish economy, and they become frightened that somehow, they don't quite understand how, that inflation is going to rise, and they decide to spend money because they fear the loss of real value that their money will have in the future. So if one motivation is confidence, another motivation is fear, but both motivations are capable of generating the dynamic that carries us into a more inflationary world. And at the moment, I think probably the way that the wind is blowing is towards governments deciding to run bigger deficits for longer. I hope the fiscal activists don't get their chance to put their policies into practice, whereby they would actually decide to spend additional monies in order to try and jolt the economy onto a better growth path. I think that would be utter folly in our circumstances. But either way, I think the danger is that it's the public sector that becomes the agent of inflation in the near term.
Right. So if I can sort of paraphrase what you're saying, you see quite a substantial shift in preference from preference for money to preference for goods as being a major risk over the next 3 or 4 years. Have I got that right?
Yes, but obviously not only for goods, but for tangible wealth as well.
Yeah, exactly. For productive assets, if you like, and so on. Well, it's been absolutely fascinating, Peter, and I'm very grateful that you've taken time out to talk to us, and perhaps we might do this again sometime. So on behalf of actually before we go, how do our listeners find you? Because you've got an economicperspectives.co.uk, is that right?
Yes, that's our website. Yeah,
that's the main way. And I think actually that if they just Google you, they'll come up with with you, because your footprint, I think, is all over the internet. So, which is great. So once again, thank you very much indeed.
Pleasure.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.